Hello, everyone, and welcome to the Quality Investing Podcast. I'm your host, Jake Barfield, the founder and portfolio manager of Asheville Capital Management. In today's episode, I have Hideaki Wada joining me for an interview. Hideaki is the president and CEO of HIKARI TSUSHIN, a Japan-based business that is a reseller of electricity, gas, water, telecoms, and insurance. HIKARI TSUSHIN has grown its operating profit at a 10% compound annual growth rate for the last 5 years, while generating north of 30% returns on invested capital. But it has also grown net income by 24% per year and comprehensive income by 32% per year over the same time frame. The reason for this extraordinary growth is because the team at HIKARI TSUSHIN has been reinvesting the profits from its operating business into a portfolio of public equities and private businesses. This portfolio has compounded at 17% per year. Over that same time period, the Japan Small Cap Index has only grown at 4% per year. So clearly there are above average capital allocation skills at play within HIKARI TSUSHIN. Today we have the great privilege of being able to peel back the veil a little bit to get a glimpse into the mindset of HIKARI TSUSHIN's CEO. When you listen to the interview, you will hear a female responding to my questions. This is our translator. If you are fluent in Japanese, I will be publishing a Japanese version of this episode as well, in which you will hear the translator asking my questions and Mr. Wada responding in his own natural voice. But first, our required disclosures. Nothing in this episode is investment advice. I highly encourage you to do your own due diligence and to draw your own conclusions, or to outsource your investment decision-making to an investment advisor like Asheville Capital. Without further ado, please enjoy my discussion with Hideaki Wada. Welcome to the Quality Investing Podcast. I'm here with Hideaki Wada. Thank you so much for taking the time. I think to start the call, can you tell us a little bit more about your personal background, who you are, and how did you get into the position that you occupy today?
I graduated from a university in 1997 and joined HIKARI TSUSHIN. I could be the number one as a salesperson in year one. And my customers in those days were corporate customers. I were selling telecommunication lines to these customers, and I could be the number one salesperson. So in the first month, I became the number one out of all of the new grads. And then in the second month, I could become the number one on a nationwide basis, even including my senior salespeople. Then for the 5 consecutive months, I could be the number one on a nationwide basis. And then I got promoted to become a team leader. And since then, I've been selling cell phones. I started various businesses. I acquired water company and also electricity. I developed electricity business and I became the president 5 years ago. I believe one of the most important cultures we have as HIKARI TSUSHIN is that regardless of your education, your gender, age, religion, nationality, as long as you can perform, you are going to be promoted. In that sense, I believe I am being able to be the president because I've been performing the best.
That's a very helpful background. So thank you for going into detail. For an American investor who has never heard of HIKARI TSUSHIN, how would you describe what this business is?
First of all, HIKARI TSUSHIN, our business is basically what we call stock business or recurring business. What we are selling includes communication lines, waters, electricity, gas, and insurance. And of course, we are generating profit, and the profit we are generating, we are making reinvestment in securities. Now, our portfolio size is 1.2 trillion yen equivalent. And our investment style is value investment. Like Berkshire Hathaway, if we look at our portfolio, 80% or so now we are investing in Japanese companies. We are also quite active in conducting M&As. Sometimes we start making investment in a company, and as a result, we may acquiring the company later, or we are also acquiring companies who are not listed. That means HIKARI TSUSHIN consists of 3 parts. We have our business, we have investment, and we are doing M&As. And these 3 elements are generating synergies.
Can you describe those synergies in a little bit more detail?
Well, as mentioned earlier, we are making investment in a lot of companies. Actually, we are making investment in approximately 700 companies. Most of them are Japanese. And all of them, we are making investment because they are undervalued. And these customers, they do have their customer network. For example, there is a company whose business is managing rental or condos. And if that's the case, we can leverage their customer network. We can sell our water server product. We can sell electricity. We can sell gas. So there is clearly a synergy between our investment and our core business. And if we look at the companies we're making investments in, there are 34 companies we have more than 20% stakes. And with the big one, we have like 47% stake. At the end of the day, we may conduct M&As. We may totally acquire these companies. By the way, if we look at the current profit we are generating, out of the 100 billion yen profit we are generating, approximately 30 billion being generated by the companies we have been acquiring. And one of the businesses of the water server business called Premier Water. This is a company we acquired. This was anyway a listed company, but we acquired this company. When we are acquiring these companies, we are acquiring off the markets.
Okay. Could you walk through the top 2 or 3 businesses that make up your revenues, the top two or three as a percentage of total revenues, and talk to me a little bit about what those businesses do and what the return on capital is.
Out of our total sales, the biggest sales contributor is energy e-business. We are selling electricity and gas, which accounts for approximately 30% out of our total sales. And in terms of operating profit, it also all consists close to 30%. The second biggest business we have is the communication line business, telecommunication, and followed by beverages. Moving on to IRR, starting from energy business, electricity and gas, 5-year IRR approximately 30%, communication line approximately 35%, and beverages approximately 25%. On a total company basis, Hikari Tsushin total, we are maintaining 30% IRR, 30. And our company is not going to allow this IRR to go below 30%.
Okay, so something I'd like to understand is you talk about the asset-light nature of your business, but you're selling gas, you're selling electricity, you're selling telecommunications. How do you sell these while not owning the production facilities? I guess said another way, how do you generate such attractive IRR or return on capital while being asset light?
First of all, anytime we start a new business, we are making sure the business is going to be fabless or a business which requires no assets. And by the way, yes, we do have electricity business and gas business, but we do not own any power plants. And we do have a telecommunication business, but we do not own even a single oil base station. Even our sales team, we do not have directly hired sales team. We are relying on distributors, meaning the size of office we have can be very small. If there's any exception, that should be the beverage business. We do have plants for this water coolers. We need to produce these coolers. So this company is listed and we've been financing.
What is allowing you to capture such a high yield in each of these businesses, though? What is your competitive advantage? I guess is another way of asking it.
Well, there are several. Let me explain one by one. Number one is we do have a culture where everyone is going to calculate the yield. More specifically speaking, we are not going to make any investment, even 1 yen, if we cannot know what is going to be the yield of the business. And we have a very austere culture, and we have very low-cost operation. It should be our sales network. Our sales partners actually counts like 1,000 or so, meaning we do have approximately 20,000 salespeople working for us. they are not consolidated, by the way. By the way, out of these 100 or so all sales partner companies, approximately 1/3, they were originally working with us. They used to be our employees. They got independent, and now they are running their own businesses. And almost all of these 100 companies we are making investment in, although most of them are private companies. And we are making sure that they are exclusive. We do have contracts with them. We are not going to allow them to have same business with our peers or competitors.
Okay, thank you. What gives you the ability to forecast the yield that you expect to earn with a high degree of accuracy?
First of all, we are calculating the CAC, customer acquisition cost, in a very detailed manner. And of course, we also calculate the expected cash flow this customer can generate in the future. When we do this calculation, we are taking the potential or churn ratio into consideration, and we are also taking how much the cash flow in this customer can generate in the future. And we are also being very conservative. Our finance division, they are adding or multiplying premium risk to the numbers we are calculating for us to be very conservative, calculating the recurring earnings the customer can generate in the future. I mentioned a premium, but this is about discount ratio.
Okay, thank you. So how would you describe the investment opportunity for Hikari Tsushin today?
We're talking about our investment business, right? Making investment in securities.
No. Why should a shareholder, why should an investor own shares in Hikari Tsushin?
Why investors should make investment in Hikari Tsushin?
That's right? Correct.
We are so undervalued at this moment. So right now should be a big opportunity.
Can you describe that in a little bit more detail?
Well, our market cap is now 1.4 trillion yen or so. And our net cash asset is approximately 800 billion yen, meaning that if you do the math, that means that our value is only 600 billion yen or so. However, our business is generating 100 billion yen cash flow. Therefore, we believe our share is quite undervalued at this moment. In terms of multiple, it's now like 6 times. And this information is available on our presentation material, but actually over the past 5 years or so, our own equity has been growing by faster than 20%. So again, we believe that we are quite undervalued at this moment.
Okay, got it. So let's talk about the portfolio performance a little bit. You've compounded your portfolio at 17% per year for the last 7 years, despite owning more than 600 positions in your portfolio. Can you please help me understand how you've achieved this success? What have been the primary contributing factors to this?
First of all, the background has been, in Japan, there has been so many undervalued shares being just left over. And what is different if we compare ourselves versus general funds? We are making investment with our own cash, so there is not any time limit. We do not need to hurry. So we do not need to exit within a certain period, meaning as long as the share is undervalued, even when the liquidity is so low, we can actively make investments. And we are making investment only when we are finding the name is too undervalued. If we need to spend time to analyze, but to figure out whether the name is undervalued or not, we're not going to make investment in. The names we're making investment in are clearly undervalued. We need only a second to figure it out. Or if I share one example, such company should be a company whose cash is bigger than the market cap and who does not have any debt, and the business is generating cash flow every year. Actually, there are so many such companies in the Japanese market. However, although there are a lot of them, they are just being left over. And the reason is because the daily transaction value is just too low, or the market cap is just too small, or the liquidity is just too low. And we're just purchasing them. However, once the company we are making investment in starts to found that our holding ratio is going to be increasing from 10% to 20% and 30%, then typically they start to increase their dividend or conduct share buyback. Meaning that on a long-term perspective, mechanism-wise, we are likely to enjoy quite a high performance. Actually, sometimes we are even finding companies because they do not want us to increase our holding, they do not want us to take over their business. They are deciding to go for MBO and with like 40 to 50% premium. Meaning, no matter what the scenario is going to be, it is for sure we are going to be profitable.
It sounds like you've developed a reputation as an activist in Japan. Do you typically advocate for change within these businesses that are trading very cheaply?
No, we are not an activist at all. We have never sent any request to these companies. Sometimes we do have meetings with the top management of these companies, but we have never asked them to do something. And actually, we have never made any shareholder proposal.
Is there anything else that you look for in an investment candidate aside from it being extremely cheap?
Basically, we are making investment in a company who is running stock or recurring type of business and whose financial stability is good. And running a stock business, recurring business, it means the expected earnings is not on the balance sheet as of today, but they are going to keep generating earnings in the future, meaning these businesses typically are resilient anytime a pandemic or war or disaster is going to happen.
Okay. So help me understand how you select where to allocate your capital on an ongoing basis. You basically have four options. You can invest into the organic growth of your existing businesses. You can purchase an equity stake in a business. You can pay a dividend, and you can repurchase shares. How do you choose between those four options?
Well, let us answer this way. We believe that the strongest growth driver for our business is to keep growing our business because we are saying the business IRR is going to be 30% 5-year time, and we are going to maintain this. So the growth investment is going to be the highest priority, followed by the investment in the equities. If we have excess cash, we are managing them by making investment in companies. And here, the IRR has been 17%, 7-year period. Talking about our dividend, since our business is a stock recurring business, the earnings should keep increasing. And accordingly, we believe that the dividend we can return to the shareholder should be increasing. Talking about share buyback, as mentioned earlier, when our share price is going to be below our intrinsic value, then on an as needed basis, we are likely to conduct share buyback.
You've stated in this conversation, as well as elsewhere, that you believe that HIKARI TSUSHIN stock is deeply undervalued, trading at 6 times earnings, despite the fact that you're generating 30% return on capital and growing book value north of 20% per year, and that you expect to continue that. So my question is, why aren't you buying back more shares?
Oh, that is because we do not want to get delisted. By the way, in Japan, about 3 years ago, the rule was updated. And now the rule says that if the liquidity ratio goes below 35%, then the company is going to get delisted. And we have 7% or so till we reach this 35% in terms of yen. That is equivalent to 100 billion yen or so. That's the amount we should be able to conduct additional share buyback.
I'm sorry, could you explain that just one more time? I'm not sure I fully understood.
Okay. There is a rule now in Japan. TSE has a rule which was updated about 3 years ago. And now this rule says if we want to be listed in the prime market, there are some conditions. And one of them says the liquidity ratio, floating ratio, has to be 35% or higher. And if we do additional 7%, i.e. 100 billion yen or so share buyback, then we are going to hit this 35%. That's the reason.
Okay. So what needs to happen in order for you to increase your share buyback? So you're saying if you buy back 7%, you can't buy back any more forever. Is that what you're saying?
Yes, your understanding is correct. As long as we want to be existing in the prime market.
Okay. That's interesting. Let's pivot a little bit. As you continue to grow your business, it will be increasingly difficult to grow your earnings per share at similarly high rates of return. It's just a simple math that the bigger you get, the harder it is to produce attractive growth on that higher base of business. So how do you plan to continue to generate shareholder value at a larger scale in the years to come as growth inevitably slows down?
First of all, the answer should be M&A. When we say M&A, we are interested in both listed companies and non-listed companies. Listed companies, there are a lot of undervalued companies as we've been discussing, and we may want to conduct M&As. And talking about the private companies, when they come across with a problem, we should have opportunity to purchase them with a low pricing. These should be considered as our strong growth drivers. Having that said, even thinking about the current scale of our business, we believe that at least for the coming 5 to 7 years, we should be able to keep growing our business while achieving the current yield. Having that said, once our profit scale is going to be exceeding 300 billion yen or so, then if we just keep sticking to the existing businesses, it may become more difficult to achieve the growth. And once the profit level is exceeding 300 billion, we believe that the IRR, 30%, is likely to slowly come down. However, we are not a company who are aiming to grow, to scale the business while sacrificing the yield. If we can't grow like we are growing at this moment, what is going to happen is that we are going to return 100% to the shareholders. Well, growth has to be a quality growth. Our shareholders are leaving their important cash to our business. So we should use them very well. We need to make sure that we make quality growth. We are not going to force just to scale the business.
So to what extent has Mr. Yasumitsu Shigeta trained you or taught you over the years? What are the primary things that you've learned from him? And just for our listeners here, Mr. Shigeta is the founder and chairman of HIKARI TSUSHIN.
First of all, he trained me to make sure I understand and solve things very simply. People tend to take on complicated or difficult challenge. However, our business is quite simple. We are going to win in simple or easy areas. That is something I learned from Mr. Shigeta. Another thing I learned from Mr. Shigeta is this no risk, high return concept. We are always exploring for certain yield. However, what our business is different from others is we are not willing to take risks. And if there's anything else, that is about keep learning things, keep being interested in things. If we do no longer have that kind of mindset, we're just going to be losing our power. If there was no Shigeta-san in this business, I believe that our IRR could be 10% lower than what it is today, because that's easier. And if you look at the world, there are so many companies who are enjoying this easier but lower IRR environment. Yeah. That's it.
Okay, thank you. Over the years, I've looked at a lot of Japanese businesses. I've spoken with well over 100 Japanese presidents or CEOs, and you are one of maybe a handful of CEOs who talks about things like earnings yield and return on capital and prioritizing shareholder return Can you just help me understand why it is that you have this different mindset relative to your peers?
Well, the baseline should be the fact that not only myself, but also Mr. Shigeta and Hikari Tsushin as a company is always making effort to have deeper understanding on capitalism. In other words, we've been always thinking why over the past 3 decades or so, US has kept growing and being able to be the number one in the world. On the other hand, Japan, we have just been losing our momentum. I believe the answer to this question means a lot. But a lot of Japanese people, they are not noticing this situation. That is exactly why there are so many undervalued companies existing in the capital market. If you look at Japanese top management, I have to say that they are very good in operating businesses, executing businesses. However, when it comes to capital allocation, I have to say that most of them do not have good understanding. And thinking about why these top management do not have a good understanding on capitalism, I believe that the regulations, laws in Japan are also causing some impact because in Japan, legally, we cannot let people go. We cannot fire them. Meaning that actually the capitalism is not well functioning in Japan, and that should be the reason why Hikari Tsushin is being able to come across with a lot of opportunities.
Why is it that CEOs don't understand capitalism?
It should be related to the market environment. In Japan, even if you do not care a lot about shareholders, you can still be listed in this market.
Okay.
That should be one of the important reasons. By the way, I will ask this question to the companies we are making investment in. I will ask why you don't have good understanding on capitalism. So we may have the answer, better answer next time.
That sounds great. I'd love to get a survey from the 700 companies that you own on why they don't understand. That's great. So you mentioned that you've studied a lot of businesses and capitalism, and it sounds like you've studied a lot of US businesses, and that's evident because you previously partnered with Constellation Software. Can you talk a little bit more about what businesses you have studied that you admire and that you wish to emulate at Hikari Tsushin?
Thinking about business style we are learning from, definitely I will say Berkshire or Hathaway. We learn from them about value investment. If you look at their headquarters is also austere, and they only have like 20 employees. They are located in suburban areas, Omaha, and they are being able to be such a big company. And talking about Constellation Software, the company you mentioned, we learned a lot about M&A from them. Also, I will pick 3G Capital. They are the number one beer brewery. They have a Budweiser brand, and we are learning M&A from them and also how we should operate the businesses after we acquire businesses. In addition, we are learning from Danaher Corporation as well. We've been learning low cost operation and cost improvement know-hows from them. We're also learning from Brookfield. We've been learning how we should make investment while leveraging, while enjoying some leverage. And there are a lot of wonderful companies operating on a global basis. We are always finding another one and keep learning from them. One thing in common is we are learning a simple business. That means that we have never chosen companies like Google or OpenAI as a company we are going to learn from. I am not good at complicated things. I believe that there are a lot of ways we can earn more while keep focusing on being simple.
That's interesting, though, because you own an equity stake in Google, don't you?
Yes.
Got it. So you clearly have some capital allocation skills. You've worked your way up to the top of this company and you're allocating capital appropriately. But what I want to understand is how you take this approach and embed it in the culture of your company. How do you incentivize your employees to behave in ways that are responsible for their roles and for shareholders?
Well, I believe that one of the things we have to have is to make sure all employees are going to be the shareholders, because then everyone can feel this ownership of the company. And it's about the form of the company. We are not a centralized company. Rather, we have a lot of delegation in each field. It's like we have a lot of teams who are operating their own companies. And with that, we believe that everyone can feel more ownerships. Meaning, at Hikari Tsushin, there's no such a person like Elon Musk, including myself. Because one of our business management important themes is the company is going to be strong, not because of a certain person, but as a total company.
You have an interesting shareholding program where you encourage your employees to own shares in Hikari Tsushin. Can you talk a little bit about that program as well as your own incentives to produce shareholder return?
First of all, our employees, every month when they are making investment in our stocks, company is going to provide 20% equivalent financial support. And talking about my own compensation, it's calculated based on the equity capital. It's several percentage out of the total all capital. So my compensation is like fund manager's compensation. That's my basic salary, and in addition, the recurring earnings growth, 10%, is going to be reflected into my additional compensation. However, compared to overseas business owners or president, I have to say that my salary itself is much, much less. And the reason is because I am happier rather than paid by this salary. Well, I am happier paid by dividend rather than paid by this salary.
Do you own shares in Hikari Tsushin yourself?
I have to say my whole asset invested into this company. By the way, Hikari Tsushin is the only name I am making investment in. I am not shareholder of any other companies. By the way, ever since I joined this company in April 1997, every month, I've been accumulating my investment. I now have more and more shares. Every month, I've been making additional investments.
Wonderful. Thank you. So is there anything that we haven't discussed yet that you think is important for listeners to hear?
Let us tell you that we believe that all of the earnings we are generating belongs to our shareholders. Our shareholders are just leaving their assets with us, and we are responsible to grow these assets. And if that is not going to happen, that's going to be the time we are going to return all of the assets to the shareholders. In that sense, we believe that one day in the future, 100% of our assets are going to be returned to the shareholders. And the very final message is, again, right now, our share price is so undervalued. Now is the best timing to make investment in. Otherwise, it will start going up in the near future. Don't miss the opportunity right now. By the way, right now, we are paying 40% returning. We are returning 40% back to the shareholders as dividend. And the remaining 60% we are keeping as retained earnings. We often hear from investors that we should increase the dividend. However, on a long-term perspective, we believe that this 60% retained earnings does make sense, because we are saying that our business is achieving 30% IRR, our investment achieving 17% IRR. If we can keep achieving this level, we believe that it should make more sense to keep this 60% equivalent as retained earnings. That should be more beneficial to the shareholders on a long-term perspective.
Got it. Well, thank you so much. This has been a fantastic conversation, and that's it.